Hi there, I'm Max Keiser. This is the Keiser Report. Have you checked out KeiserReport.com? Yeah, it's got links and stuff to everything we talk about. That's right, Stacy.
Yes, at KeiserReport.com, I put all the headlines, the links to the headlines we talk about. And you know what? People always ask me that on the YouTube. So I thought, why not start KeiserReport.com and provide the links for people so that they could stop harassing me on Twitter.
That's a good idea.
So, speaking of harassing people on Twitter, that is basically the job of our commander-in-chief, the President of the United States, Donald Trump, or at least that's what he thinks it is. And he harasses people all day long on Twitter. In the past week, he started this week off with harassing Jay Powell over at the Federal Reserve Bank. And he tweeted, "Our economy is very strong, despite the horrendous lack of vision by Jay Powell and the Fed. But the Democrats are trying to will the economy to be bad for purposes of the 2020 election. Very selfish, exclamation point. Our dollar is so strong that it is sadly hurting other parts of the world. The Fed rate over a fairly short period of time should be reduced by at least 100 basis points, with perhaps some quantitative easing as well. If that happened, our economy would be even better, and the world economy would be greatly and quickly enhanced. Good for everyone."
This brings to mind two shipwrecks. One, the Poseidon Adventure, and the other, the Titanic. On the Poseidon Adventure, they had to realize that the ship had flipped over and was upside down before they could escape. And then with the Titanic, you have these negative interest rates, and so the economy is sinking. But if you remember the Titanic film, or, based on the Titanic sinking, the front of the boat, the bow, started to head down into the ocean. The tail, not the bow, but the tail, okay, it flips up.
Yeah.
So those are the people who buy these negative rate bonds. They have the sense that their value of their equity, of their bond equity, is going up as the Titanic, that is the U.S. economy, points down to the bottom of the ocean. Then when it achieves a perpendicular on the horizon there, then the entire thing sinks. So Trump is, we are about 5 to 6 degrees away from perpendicular, and Trump is calling for more of a faster sinking. He wants the U.S. Economy to sink faster, and and I thought when he came into office he had some brains, but it turns out he is completely out of his mind.
So this is the end game of any fiat system, I think. This is the first time we've had a global fiat system. All fiat prior to 1971, as we've pointed out many times, we had the gold standard. And against gold, you could devalue your own currency. What we saw in the first Great Depression, the global Great Depression, was a beggar thy neighbor sort of policy. So everybody, reduced their own currency against gold faster and faster to try to beggar thy neighbor. We're seeing the same thing. Of course, with the U.S. dollar, I think part of the problem is we can't really go negative. We'll see, Alan Greenspan this past week said the U.S. dollar can go negative, our treasury bonds can go negative. However, will that destroy the U.S. dollar as a global reserve currency? So Europe going negative has kind of beggared thy neighbor, what Trump is responding to, I think, when he sees them being able to cut rates to negative. And in terms of that, Titanic, people at the top of the part that's not underwater yet, they think everything looks fine and it's hunky-dory and they're dry, right?
Right. So something like 94% of all the sovereign bonds that are yielding positive rates of return, have a positive yield, are the U.S. Treasury.
And U.S. corporate debt. Even corporate debt in Europe is negative.
94% of bonds that have a positive yield are U.S. bonds.
Yes.
So that would be just a few degrees from perpendicular. So
Yeah.
I think the U.S. will go to negative interest rates.
Yeah.
And I think that will be when the entire global economy zips right down to the bottom of the ocean. And, gold and, of course, Bitcoin will skyrocket.
I mentioned Alan Greenspan. He's the former head of the Federal Reserve. In America, before he became the Federal Reserve Chairman, he, of course, was a big gold bug and wrote some books about gold. And then he started to speak in Fed speak. He invented Fed speak, but I think that was really his own way of cognitive dissonance. He knew that it was all fake, but he had to pretend that he was, he was speaking truth in his language, in his mind, but nobody could interpret it, and they only read what they thought they heard.
Well, he famously said, if you understand what I'm saying, you didn't hear me.
Well, that's a good way to put it, because he says, Greenspan says, there is no barrier to negative yields in the United States. But the other point I want to point out that he said, because this is mirrors what we've said here on Keiser Report, he said, why people continue to buy long-term treasuries at such low yields may be also due to forces having altered people's time preferences. But there are hundreds of years of history showing the long-term stability in time preference, so these changes won't be forever. So he's saying, yeah, rates could go negative, but obviously this is because something has changed humans' time preferences, investors' time preferences, being all fiat since 1971. But he's saying that the long-term stability, people will come to their senses one day, and this whole thing will crash.
You know what's really strange is that in these bond markets, the liquidity to sell doesn't really exist. The Fed and other central banks have tried to sell their bonds on their balance sheets. They couldn't find any buyers. So they stopped. They stopped quantitative tightening, and now they're back to easing, and they'll go back to quantitative easing, QE4 in America. So without any market to sell their bonds, the path of least resistance is to keep buying bonds, particularly since they're being given essentially free money. If you can borrow for nothing and your interest rate is zero or less than zero, it's not a market where you have to buy from a seller. You're just printing gains out of thin air, effectively. So this market is so strange because there's no market for a sale. There's only markets for a vertical ascent. And hence the prices are going negative. The yields are going negative, right? So this is the Poseidon Adventure mixed with the Titanic in one colossal sinking of the global economy right now. We've got Donald Trump starring with the ghost of Paul Newman on the bridge of the Titanic, watching as they engineer a colossal failure of the global economy, and without the benefit of owning any gold. Less than 1% of investable assets around the world, and there's 100 trillion, own gold.
There is a lot of gold at the bottom of the sea, thanks to many ships that used to have to carry the gold across the Atlantic.
Good point.
It's all
That's
down
where
there.
you find the gold.
That's where our answers will be.
That's it. We figured it out.
Also, you mentioned the strangeness of what's going on, and even Alan Greenspan, in his Fed speak, his elliptical way of speaking, is saying things are strange because time preference seems to have changed radically. People no longer value time. Well, the bond black hole is getting larger and scarier, with a third of the global market now negative. The quantum of negative yield debt doubled to 14 trillion in the first half of 2019. Its growth now appears to be hitting warp speed because it is melting up in terms of the quantity of these negative yielding debts. It was at 17 trillion. I don't know. By the time we speak, it could be 18 trillion. By the time this airs, it could be. I have spoken, so by the time I spoke, it could be 18 trillion.
Well, remember that, getting back to the Titanic, they hit the iceberg. And, it wasn't, I've seen, there's a brilliant video on this online. It has all 2 hours and 40 minutes of this hit the iceberg and the sinking of the Titanic redone in real time. It's beautiful. It's fantastic. This is how you can understand the economy. So they hit the iceberg, and they're taking on water for 2 hours. It took 2 hours before the actual sinking began in earnest. And, this is where we are. That's what a negative interest rate is. In 2008, the global economy hit the iceberg. We had a credit freeze. The global economy died. It's been this stinking Epstein-like corpse since 2008. And the central banks keep pumping in the cash, but the market takes that free cash and they buy bonds to the point where the yields are negative. So that's the capsizing of the boat. And now we're almost vertical, and we're almost ready to hit right down to the bottom of the ocean, where all the gold is.
Again, to mix all our metaphors, we have passed the event horizon, and apparently, according to physicists, once you pass that event horizon, there's no going back. You're going to be turned into spaghetti and thrown through that black hole. What lies on the other side? I don't know. Perhaps it's all that gold at the bottom of the ocean, and that will rescue us. But of course, Germany, Denmark, Netherlands, and Finland are all now negative all the way out to the end of their bond horizon. And whether or not the U.S. will go there, Alan Greenspan says it might be possible. But I want to turn to a quote here from Hong Kong-based Macquarie strategist Victor Schwetz, because he says that this the destruction of time value is, again, like physics. You know, that's not supposed to be something that happened. Alan, if Albert Einstein were alive today and he looked at what's happening in the bond markets, I think he would be, you know, sounding the alarm and telling everybody that we've hit an iceberg and move on. So he says that we've destroyed the time value of money, and this is the core of finance theory. So the fact that we've destroyed the core of finance theory, we've had this meltdown. He says, this has serious consequences. The destruction of the cost of money not only interferes with credit cycles, but also keeps zombies alive. It encourages speculation and discourages productive investment. It spurs a race to the bottom with beggar thy neighbor strategies as nations compete to maximize returns from an ever declining utility of debt.
Right, GDP. Adjusted for actual inflation, including stuff that people actually are exposed to, like healthcare, education, and food, is negative. Has been for a few years now. The economy in the U.S. is shrinking right now.
Yeah, it used to take $1 of debt, you would get $1 GDP.
Yeah, we have negative GDP.
$2 of debt, $1 GDP. Then now it takes $5 of debt to get $1 GDP. That's obviously... It doesn't work on mathematics.
You know, and the thing about Trump's statement is that, I mean, it can prove he's lost his mind in one very simple equation. If the economy is growing, you raise rates. That's the economic orthodoxy. If the economy is shrinking, you lower rates. Trump is saying the economy is growing, but we need to lower rates. That's an oxymoron. That refutes all economic orthodoxy and makes only an insane person would make that statement.
Well, because he sees the propaganda-free numbers, they do massage the numbers, and I think if you're closer to the Treasury and get to see the real details, you know that it's taking ever more debt to stand in one place. I think that's interesting that it's just the math, right? It's the maths, as they would say in England, and it's interesting that Bitcoin is about believing in math. We have Andrew Yang sent to us, and he's all about math. And he even has the hat now that he sells on his site. It's all about the math. So I think people are starting to recognize the physics of the situation of passing the event horizon. I don't know if it's too late, but...
Gang is in the house, for sure. And they're putting forward mathematical solutions to a mathematical conundrum. How do you put 20 pounds of garbage into a 5-pound bag? That's the attempt by the American economy. It's physically impossible. Yang is saying you need a 20-pound garbage bag to fit 20 pounds of garbage. And
that's what gold has always been. It's mathematical number. You know, it's number on the chemical
79 on the periodic element table.
Maths are making a comeback.
It's all coming back. Mathematically, I can guarantee we'll be back after this short break. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Wolf Richter of wolfstreet.com. Wolf, welcome back.
Thanks for having me back, Max.
Trump is demanding the Fed cut interest rates by 100 basis points and restart quantitative easing. Your thoughts, Wolf Richter?
Yeah, that's interesting because also Trump is saying that this is the best economy ever. So why cut interest rates by 100 basis points when they're already low when this economy is so red hot? And, you know, we're sort of torn in between the two, and the economy is probably in the middle. Yeah, it's not the best economy ever, but it's pretty good shape, except for manufacturing is not good shape. But services are good. Consumer spending is growing. Retail is doing okay. So, in this sense, economy is doing in the middle of the range of the last many years, and so there's really no reason to cut interest rates from the already low levels. And of course, the market has already cut those yields down way by a large amount, and so the stimulus in terms of lower rates has already arrived in the markets. I mean, mortgage rates have come down a lot. Corporate borrowing costs have come down, so that's already happened without really the Fed cutting much of anything. They cut 25 basis points, and the market rate started coming down 8 months ago. So this financial easing has taken place in the market without the Fed doing really any cutting. And I don't think it's necessary to cut. I think the market is overreacting to this, and I would like to see short-term rates at where they were, about 2.5%, and I think just above the rate of inflation. I think that will be about right. Rate of inflation is measured by CPI, as we usually do. Not some other rate of inflation that we might personally experience, which could be a lot higher.
But this whole idea that the economy is doing great, let's raise rates, goes against orthodoxy in terms of if the economy is going great as Trump says it's going, you raise rates. That's what you do. If the economy is doing poorly, you lower rates. So he's being duplicitous here or uninformed. Just a few years ago, he was saying the opposite, that the Fed, by cutting rates, is undermining the economy. And is it just become an expedient for him to mouth the corporate line and defend the bank's outsized profit margins? Or has he become less informed since he's become president, Wolf?
Well, I don't think that Trump is uninformed. I think he plays a political game, and he has his own objectives, and sometimes he needs to make people happy over here, and sometimes he needs to make people happy over there, and so he says these conflicting things, and it's driven by a political objective, not really by the economic essence that we're facing. And so he'll change his mind. I mean, during the campaign, he said, like you mentioned, interest rates are artificially low, the stock market is fake, and there's a political objective behind everything he says, and I think that's how we have to look at it.
Oh, okay. So the term Trump derangement syndrome, that was popularized by some quarters of the political spectrum, in fact, could apply to Trump himself when it comes to interest rates in the economy. Now, a strategist out of Hong Kong recently noted that negative rates suggest, quote, an ever-declining utility of debt. Okay, that's an interesting phrase. That nation is now engaged in beggar thy neighbor strategy. First, is Trump right to respond to the attempts by Europe? So to expand this interest rate conversation to a global sense, what Trump is seeing is that rates are going down in Europe, and that the U.S., to remain competitive, is supposed to be lowering rates. But the larger question here would be an ever-declining utility of debt. It's a phrase you go into in your recent podcast in great detail. Can you expand on this?
Clearly, if you have two major economies such as the European, the Eurozone, and Japan cutting rates below zero, that has an impact on other economies such as the United States economy, and it changes exchange rates and so forth. And so that could be some disadvantage. But there's some real problems in cutting rates too low, and we've seen those in Japan and in Europe. Japan has had 0% rates and negative rates for 2 decades. And the banking stocks are down 92%. I just looked at it the other day when I did my podcast, 92% from the bubble high in 1989. So that's 3 decades ago, and bank stocks have plunged by 92% since then, have not recovered. The European bank stocks are down where they were in the 1990s. Banks need to be healthy for them to supply the kind of infrastructure that a modern economy needs. And if you don't have healthy banks, you can't really run a healthy economy. And very low interest rates or negative interest rates make it very difficult for banks in their core business to make money. And so they venture into very risky activities that might, just to make a little bit of money. And these risky activities make these banks much more fragile and much more risky as a core element of the financial infrastructure. And so they don't do what they're supposed to do, and they just chase yield, and they're paying, they're taking on extensive risks, such as in collateralized loan obligations, which are now really hot at banks. And so you have the situation where bank stocks, bank investors feel like the banks are way too risky. You have an economy that's becoming unhealthy because the standard thinking, the standard decision making in an economy is pricing of risk, and that's expressed in the cost of capital. So something gets to be riskier, investors demand a higher yield, and that helps corporations identify how much risk they can take and so forth. And when you take rates to zero or below zero, that whole calculation goes out the window. Now you have malinvestments as a consequence. You have all kinds of wasted resources. You have companies taking way too much debt because it doesn't cost anything and they're not using it for anything productive. So you're buying back their own shares and those kinds of things. And so you have an economy that really doesn't perform well. And you see that in Japan and you see that in Europe. In the United States, we've had rate hikes in 2018 and 2017, and our economy has outperformed that of Europe and Japan. So, I think negative interest rates, negative yields are a very destructive thing. They're maybe okay, very short term to deal with an emergency, but now that's been going on for years, and there's no emergency, and we're altering the way an economy functions. We're taking away the decision-making model that we have relied on forever, which is the pricing of risk, and we're replacing it with some kind of wishy-washy concept that nobody really understands and knows how that's going to turn out. So I think it would behoove the Fed to be in a leadership role and say, no, this has gone too far. These negative interest rates are we need to let the world know that we're not going to do this. Never, in the past, they've said this pretty much. They've said negative interest rates are not on the table, and it would be helpful if the Fed provided some leadership in this before we get some really messy reset. At some point, that's what we'll get. We get a reset, and that's going to be very messy when that happens.
So banks lose with low rates, and they lose more with negative rates, and banks are a fundamental part of the economy. And so the question is, why is this allowed to continue? It would be like forcing a car manufacturing company to say you can only make cars out of cardboard, and that's it. You're going to have to make a business out of selling cardboard cars, right? But you're saying, hey, banks, you're going to have to make a profit. You have to make a viable business with low to negative rates. And of course, that's an impossibility. And they're all collapsing. Bank indexes are collapsing. And the reason why is because the banks, as of 2008, are insolvent. So these low and negative rates are because they're too big to fail, according to the central banks. And they need to be kept alive, no matter how predatory they become, no matter how many good companies and good banks they push out of existence. This zombification of the global economy is metastasizing and snuffing out any possibility of growth, and therefore the debt can never, ever be paid because you'll never, ever have genuine growth above the rate of the growth in debt. So let me continue on here. So we have also established that Trump, by jawboning the Fed to lower rates by 100 basis points and engage in quantitative easing QE4, he is patently and obviously buying votes, which, again, is not, or used to be illegal, but so much of what used to be illegal in America, nobody pays any attention to anymore. All right, let's move on. So what do you think about rates in the U.S.? Can they go negative in the U.S.? And if so, can it still retain reserve currency status, that being the U.S. dollar? And will we see a breaking of the buck? Remember in the 2008 crisis, the money market fund that was going to break the buck, and alarm bells went off, and they had to write a check for $17 trillion to bail out the too big to fail banks. Well, here we are once again, breaking the buck. But the question is, will negative rates come to America? We've got about 30 seconds, and we'll hold you over. But go ahead, take a shot at it. We got about 30 seconds, Wolf.
So far, I don't think the Fed's wanting to go that way. I think they're sticking to the zero lower bound, and that's what they've been saying. I think they may restart QE at some point when there's a big problem, but I think negative interest rates from the Fed's point of view are not a priority.
That sounds like it's going to be a function also of market action. If bonds get bid up in these historic run, you're going to start to see negative yielding debt happen on the Treasury market anyway due to the irregularities and the market confusion out there. But let's have you on for another segment, but we'll say goodbye for this segment. Wolf, thanks for being on the Keiser Report.
Thank you, Max.
That's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Wolf Richter of the WolfStreet.com report. If you want to catch us on Twitter, Keiser Report, or the website, KeiserReport.com. Till next time. Bye, y'all.